Since you are studying for the CFA exam, I assume you're familiar with the financial industry. As an analyst, you'll be reading many company research reports because they provide a deeper understanding of a company. It's important that you know what these reports are and the information they aim to convey.
There are several essential components of the first report that an analyst issues when initiating coverage of a company. Most importantly, it needs to include the analyst's recommendation. But it should also have a section for the company's description, an overview of its industry, financial analysis, and valuation. There should also be an analysis of the company's key risk factors and a discussion of ESG considerations. Subsequent reports do not need to include as much information, but they do need to document and analyze all new information that is relevant to the company's valuation since the last report. The sources of information that are used to form the basis of these reports include company disclosures, public and proprietary third-party sources, and proprietary primary research. Analyzing a company's revenue drivers can be done using either a bottom-up or top-down approach, but in practice, analysts usually take a hybrid approach that combines elements of both. A company's pricing power is heavily influenced by the structure of its industry and its competitive position within it. Firms that operate in a perfectly competitive industry are price takers. In markets that are less than perfectly competitive, firms can increase their pricing through differentiation. But there is always the risk of commoditization, which is when competitors imitate innovations that make products distinct. Moving below revenue on the income statement, we need to look at how companies' costs are projected. Operating costs may be classified based on their behavior. Variable costs are directly related to a company's output, while fixed costs remain the same regardless of how much the company produces. Using this framework, a company's operating profit is equal to the quantity it produces multiplied by the contribution margin of each unit, which is its price minus its variable cost, minus the company's total fixed and operating costs. The degree of operating leverage measure, or DOL, shows how fixed operating costs impact a company's profitability. It's calculated as the percentage change in operating profit divided by the percentage change in sales, with operating profit being defined as a company's earnings before interest and taxes, or EBIT. We also have to consider the impact of financial leverage in a company's capital structure. The degree of financial leverage measure, or DFL, is calculated as the percentage change in net income divided by the percentage change in EBIT. When we multiply DOL and DFL, we get DTL, which is the company's degree of total leverage. All of this brings us to the return on equity, or ROE, which is one of the key metrics that investors use to determine whether a company is generating adequate returns. The basic ROE formula is net income divided by average shareholders' equity. But from an analyst perspective, ROE is an amazing measure because we can break it down so many different ways to isolate the impact of different components. ROE is also the product of return on assets and assets over equity, which is called the leverage and the equity multiplier. Another way that ROE can be calculated is net profit margin times total asset turnover times leverage. And finally, there's the five-way breakdown of ROE. Net income over earnings before tax, which is the tax burden, times EBT over EBIT, which is the interest burden, times EBIT over revenue, which is the EBIT margin, times revenue over assets, which is the total asset turnover, times assets over equity, which is the leverage.
That's all we need to cover in our review of company analysis. We'll continue our discussion by talking about industry and competitive analysis in the next video. See you then.